season of the year, it's time for celebrations and investments in gold. Smart investors are now aware that there are financial avenues for investing in gold which are more efficient than our traditional avenues like physical gold, jewelry, and bars and coins. The leading financial avenues for investing in gold today are gold ETFs and sovereign gold bonds. Both have their pros and cons and are suitable for different kind of needs and investment objectives. So let's try and delve deeper into that today. To start off with, sovereign gold bonds are not backed by physical gold but are backed by a sovereign guarantee, whereas gold ETFs are backed by 24 karat physical gold. If we speak about the lock-in period, sovereign gold bonds have a lock-in period anywhere between 5 to 8 years, and gold ETFs do not have any such lock-in period. If we talk about accessibility, sovereign gold bonds have a minimum purchase unit of about 1 gram. When you're investing in gold ETFs, you can buy one single gold ETF unit, which is equivalent to just 0.01 grams of gold, and in today's prices, that is barely rupees 60. So, from an accessibility point of view, gold ETFs definitely score above. Sovereign gold bonds, as you must be aware, pay an annual interest, and their capital gains while selling sovereign gold bonds on maturity are tax-free. On these aspects, sovereign gold bonds score above gold ETFs. But if you look at the liquidity aspects, gold ETFs will score above sovereign gold bonds. Let me explain that more in detail. Gold ETF units are traded like shares on exchanges, and hence you can buy and sell them during market hours at very close to market prices. So there is a sort of liquidity and price efficiency there, which is something that is missing when it comes to sovereign gold bond investments, because the secondary market liquidity for sovereign gold bonds we have seen tends to be a little low. Because of which, if you want to redeem your sovereign gold bonds before maturity, you might land up selling it at a reasonable discount, and that kind of eats into the investors' returns. So that would be the number one point. And in connection with this, because liquidity or secondary market liquidity is a problem when it comes to sovereign gold bonds, from a portfolio rebalancing perspective, that becomes an issue, because portfolio rebalancing is a part and parcel of investment portfolios. For example, if gold prices run up and your allocation in gold increases, you would want to trim your gold allocation to bring it back to the intended asset allocation, right? Now, that will not be able, you will not be able to do that with sovereign gold bonds because, like I mentioned, secondary market liquidity is lower. Contrast that with gold ETFs. You can sell your ETF holdings as and when you want and market linked prices, which enables efficient portfolio rebalancing. So I think this sums up the pros and cons of gold ETFs and sovereign gold bonds. As investors, as smart investors, I hope you make a sensible choice and choose gold backed and liquid avenues like gold ETFs and gold mutual funds for your gold investment needs this festive season. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.